Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Good afternoon, everyone. Welcome to our presentation today. My name is Joel Cundick. I'm a financial advisor on Savant's Vienna, Virginia team, so based in the East Coast. And we're in many states across the country now. Really glad to see the expansion we've had. But we've been doing work here for many years for clients in the DC area, and what I'm going to talk about today applies all over the country. So as the topic is avoiding a big tax surprise, and this is the time of year where we've kind of made it through the holidays. Most of us, there's been a snowstorm here in the East Coast, and we're trying to work our way through that. But this is the time of year when people's thoughts turn a little bit toward, oh boy, I got to get everything together for taxes. And wow, I always think that I pay too much. What should I be doing to save some money? Is there anything that I can do right now to save money? So that's why it's a good time of the year for us to be having this conversation. I think what you'll find is a lot of the things we'll talk about have to do much more with looking to the future than looking to the past. Once a tax year closes, a lot of opportunities are closed to us along with that. But what I talk about with clients in many regards is the idea of a multi-year approach to planning, to taxes, to anything. I'm much more concerned with the direction we're moving than what happened in this current year. And so hopefully some of the ideas I give you today can assist you as you map out future potential tax implications for you and seek to reduce your taxes wherever you can. Personal financial planning, I've heard it said, is much more about personal than financial planning. And that's going to be true. I'm going to give you a lot of ideas today, right? Hopefully some of these stick and work well for you, but I'm not looking at your specific case, and somebody looking at your case is going to be able to probably give a lot more targeted feedback than what I can give in this format. So we've got an agenda. We're talking about planning versus preparation. We're going to talk about some strategies that save us money above the line and below the line, and I'll cover that when we get there. There are some changes that have been filtering into the tax code from Secure Act 2.0. We'll talk about those. Then we'll talk a little bit about business succession, because it's a unique aspect of tax planning where there's a huge opportunity for tax savings. And we'll get to your questions as we can at the end, okay? So, planning versus preparation. We think, as I said earlier, that tax planning is what we do now, but really tax planning is what we start now, thinking for the next tax year. So April 15th is a deadline that sticks out in everyone's minds. We're really mostly reporting the news of what happened last year, but we have a lot of power to change the future, okay? So what do I think about most in planning for tax? It's the changes. If I am a salaried employee with a W-2 that rises with inflation every year, then the idea of tax strategy is much more just concentrated on what tax bracket am I in, what opportunities do I have for savings, do I have children, do I have education expenses, do I have a mortgage, am I giving charitably? All of the standard list of things apply in that case. And then it's really just a game of making sure I'm setting my withholdings to hit my anticipated tax bill at year end. So that's not where most people have tax questions around. The tax questions pop up at the surprises. I've received an inheritance. What do I do? I've sold a home. I sold highly appreciated investments in my portfolio. I changed my job, right? What are those kinds of one-time events? I sold a business, right? That are going to have a profound impact on my tax return, and what can I do in advance about them? I'll give you a classic example where people run into difficulty. They leave a career that they've been a W-2 employee, and they change to being a contractor or consultant working on their own. And then they're going to get paid at the end of the year. Instead of the W-2, they'll get paid with a 1099 from the company or individuals they're working with, okay? When they get that 1099, what they'll note throughout the tax years, they got a really nice check every time that entity paid them. Why? Because there were no tax withholdings, there's no Social Security withholdings, there's no benefits, whatever other benefits withholdings. It's just a pure pay. And the place I've seen people run into the most problem in that kind of situation is thinking, wow, I got a lot more money than I used to. The very first April 15th that arrives after that change, if they have not been planning in advance, they're going to be in for quite a rude awakening. Why? Because their status as an employee changed from W-2 with tax withholdings directly to the government to independent tax withholdings need to be done by myself or they won't be done at all, right? And it's not just an income issue. The income tax is one thing, but for independent people, it's the self-employment tax is what it's called. It's really both halves of Social Security tax. You have to pay to the government both halves of Social Security tax and Medicare tax, which right now is in previous year W-2, it would have only been half. The employer was paying the other half. So I often tell people when they're going independent as a contractor, think of keeping half. Whatever is coming into you, just think that you're going to keep roughly half. You'll hopefully keep a little bit more than that. But if you've got your mindset geared toward that from the beginning of the year, you're going to be much better off than if you've anticipated at the beginning of the year a huge bump in pay and you'll handle tax when you get there, but you're sure it's not going to be that big a deal. And lo and behold, at the end of the tax year, massive taxes due, far more than you expected. So changes are what we're most concerned about with tax planning. Right. If you have a preparer already, what you may have noticed is that oftentimes the preparer just gets very needy around this time frame, right? They're wanting to see all the documents. They want you to send them to them as soon as possible. Once you've sent them to them, it's kind of a black hole. They disappear for a few weeks. And then magically at the end of that, you've got a draft return that kind of comes out to you. If you've asked questions of a tax preparer during that season, hey, how is this going to impact me? Hey, what can I do about I think many people I've talked to have spoken about the experience of not getting a very responsive CPA, right? And a lot of that is because this is the most busy time of their year. They're just focused on getting through the returns. And so if you do work with a tax preparer and you want tax advice, it's far better to go to them in August, right? Probably not late September, early October. That's actually another deadline of theirs. There's an October 15th deadline that they're watching out for. But you go to August or November, these tends to be better times when you can go to your preparer and say, hey, I'm looking for some more strategy here. What is it that I can do to reduce my taxes? And you can have a much more open and well, maybe not stress less, but stress reduced conversation, right? What you'd want to bring to that is your year-to-date pay stub and anything that's changing for you in that unique year. I had a kid go to college. I've got all this tuition. How is that going to hurt me from a tax perspective? I'm taking withdrawals from a 529 to pay myself back for that. How does that impact me? You want to kind of have a list going into that meeting of here's what's different about tax year 2025. Okay. And then you want to make sure as you can that you're working with a financial advisor who is tax efficient in their approach. I'll give an example of this. There are a lot of active mutual funds still out there. All right. An active mutual fund, the idea is that it's a manager who's trying to pick investments that will do better than average, right? Do better than some benchmark, right? So instead of buying the S&P 500, they're going to buy 30 stocks that they think will outperform the S&P 500. The issue that active funds can often run into in certain tax years is that, let's say the markets haven't done that great this year and that manager is looking to turn over positions and buy new holdings. Well, you can get to the end of the year, the fund has made 5%, but you got a big tax bill because there are distributed realized gains from all of the stocks that they sold during the year. So you're trying and kind of match. You can understand paying a lot of tax when markets were really up and your portfolio was really up. It's a lot harder to understand, why did I pay a lot of taxes when my portfolio didn't gain that much money? And the reasoning for that is, in the United States, you pay gains tax the year that you sell an investment. You don't pay gains tax over the years that you hold the investment. It's beneficial to you to delay that. But you can work with an investment manager who is more tax efficient, who looks to buy funds that are not kicking off near as many capital gains on an annual basis. So that's bringing down your tax bill. And oftentimes it can actually increase your effective return. Any investment manager you're working with has to report your performance net of their fees, that they can't report your performance net of your taxes. Everybody's taxes are different, but that's the only number that matters to you, is what is your return after fees and after taxes, right? So that's another thing to kind of dig in. Maybe your tax preparer can help you with that, right? Or you go to somebody for a second opinion. They can look through and say, oh, this is a pretty tax efficient portfolio. Or no, there's some things from a tax perspective we see here that it may be causing you difficulty you're not recognizing, okay? So where are we going to go to try and save you some money on your return? There's two basic categories. We'll go to above the line strategies and below. The line is where you get to what your gross income is, your adjusted gross income. So we figure out what your total income is. So any strategies that reduce income are considered above the line. They reduce what your adjusted gross income would be. Then there are strategies that are below the line. We take deductions, we take some credits, things that happen after we've calculated what our adjusted gross income is. That's below the line, all right? So for this section, let's talk about above the line. We're trying to lower our adjusted gross income. That's going to help us not only with our federal return, oftentimes it's going to help us with a state income tax return, because many states are keyed off of the federal return. So we'd like to get our income down, right? Now, as we think about income, it often is just a matter of timing. We're not talking about when we earn more, earn less. We're talking about when the income is counted as received, right? If I'm owning my own business, I probably have more control over that as opposed to if I'm an employee of another business, right? But if I have control in any way, let me give you an example of an above the line strategy. It's not even going to come up in the presentation today, but it's totally valid and effective. Contribute to your company's 401k or 403b. If you're in a very high level of income and you contribute to a 401k in a tax-deferred manner, then you are moving income out of the current year and into a future year when you're going to take the money out. Now, if you're in a low bracket right now, then that might not be beneficial to you. Maybe you decide to use the Roth option instead. But if you're in a high bracket now, and you know you're going to be not taking that much out of your portfolio in retirement, you may want to shift income out of the current year into a future tax year. And that's what really the number one benefit of contributing to a 401k is. If it's your only method of saving, then of course we want it to grow as well. And growth, tax-deferred growth is great. But tax-deferred growth inside a 401k is someday going to be subject to taxes. So if I have other buckets I'm saving, and I'd actually rather grow those other buckets more. But the one unique thing that 401k can do for me that other vehicles can is it can shift income out of the current year and put it into a future year. All right. So that's an example of, hey, we just like to sometimes get income lower where we can. All right. What are the brackets? These are the 2024 married filing jointly brackets. So I post them up here. There's obviously different rates for single, different rates for head of household, qualifying widower. But so it's important to know what your brackets are. And then what I want you to remember about brackets in the United States, it's a graded system. It means that if I make from $201,000 to $384,000, all my income is not taxed at 24%. Only the portion of my income that is in that area is subject to that tax. My income up to 201 was subject to 22. My income up to 94 was only subject to 12. My income up to 23 was only subject to 10% tax. So it's a graded system. So even if I'm in the 24% tax bracket, oftentimes my effective tax is still somewhere more in the neighborhood of 16, 17%. All right, so there's two different numbers I just talked about there. Both are important numbers for you to know. One is, what is your effective tax rate? That's the blended tax at the end of the day. You calculate it by saying, here's my total tax owed, and here's what my adjusted gross income was. Put one above the other, calculate a percentage. That's my effective tax rate. My marginal tax rate is where do I fall in these income brackets, because that's where my tax savings are going to occur. If I'm making $250,000 this year and I contribute to a 401k, I'm going to reduce income that was subject to my marginal rate, my 24% tax bracket, right? And if I expect my income to be under $100,000 in retirement and I can be subject to 12% tax bracket, then Now you see what I'm talking about with income shifting. So these are the ordinary income tax rates, graded from 10 to 37%. There are also long-term and short-term capital gains rates. The short-term isn't in this table, and it's really easy. It's the same rate as your ordinary income. So everybody who's trying to make money as a day trader on GameStop and whatever, you know, the favored stock of the day is, if you buy a stock and you sell it 2 months later, the gain that you experienced on that stock is just going to get added to your income as taxes. If you hold on to that stock for 366 days, a year and a day, now you get this favorable gains rate where you only might pay 15% or potentially 20%. But if I've got somebody who's making $300,000 a year and we have long-term capital gains, those gains get a 9% reduced tax from what my income does. You see the favorability? This is all because the United States is trying to promote long-term investment. And so it gives a favorable rate to gains. Is that always going to be that way? No way of knowing, right? All of the tax rates that are out here on this table are subject to change, whatever Congress decides to do. But this is the law of the land, and there's a little bit more confidence in the law right now than there was about 3 months ago. That's because the Tax Cuts and Jobs Act of 2017 that then President Trump put in place, he's expressed an interest to try and perpetuate that, to really renew it, where otherwise at the end of 2025 it was going to expire. So I expect a strong chance of a new tax bill at some point in 2025, but it's probably going to rhyme a lot more with prior tax than if there had been a Democratic administration. They would have had different priorities, different things they were trying to accomplish, and they would have done different things with the tax code as a result. Okay, so I'm like to get long-term capital gains. What I really like is to not sell my securities. If I can go super long-term on these holdings, I can avoid that tax altogether. I don't incur that tax until I sell the investment. And this, I'll just give you a little side note here that it can be very helpful if you've got a parent who holds on to a stock that is highly appreciated. I'm thinking of someone I worked with who had an extensive amount of Facebook stock, very highly appreciated, right? And they were looking at gifting it to their next generation. Well, if you gift a stock to somebody else, then it's whatever your purchase price is their purchase price. But in this country, if you hold on to investment until your date of death, you actually wipe out the capital gain. So this was a situation in which it was actually advantageous to continue to hold a highly appreciated stock if there's some thought they might die in the next few years, because there was a huge capital gains tax that could be washed away altogether because of the step up in basis law in the United States. So there are ways of saving money within this. This is why it's really good to be talking with someone before you make a big move like a huge gift, selling a huge investment. It's good to talk with someone to get an idea of, hey, is this the right thing for me to do? Okay. Now we also have a qualified dividends. This just means that certain dividends paid out by companies also receive that favorable tax treatment of long-term capital gains rates. All right. We just got through a season here. You see the caveat here at the bottom of a lot of people doing selling, and you might have heard of tax loss harvesting, for example. Tax loss harvesting is it's maybe a counterintuitive strategy, but the idea is if you hold investments that have lost money and you don't really expect them to make very much money in the future, then selling them prior to a year end and realizing losses can help with offsetting realized gains you had somewhere else. However, that only makes sense in the context of, hey, do I not expect that stock to make a huge gain in the next while? Because if you expect the stock to grow, then the tax benefit is not really that helpful, right? You'd far rather have the gain in the investment than the portion savings on booking a tax loss, right? If I can book a loss that saves me, well, it reduces my capital gains by $5,000. I'm only saving 20% of that max from a federal perspective, probably more like 15% on my tax bill. if I get a gain in it, I get to keep 85% of the gain. So don't let the tax tail wag the life dog. It's a saying that I use all the time, right? Taxes are great. Tax avoidance is good as long as it's the maximizing approach and not a strategy to say the number one goal is to not pay tax to the detriment of growing my net worth. So there is another stealth tax that a lot of people are not aware of that I want to make sure everyone on this webinar is aware of. It's called the net investment income tax. This was brought to bear in 2012 as a part of the Affordable Care Act, one of the ways of paying for the Affordable Care Act. And the idea is when you top $250,000 of adjusted gross income as a couple, or $200,000 single, every dollar of investment income on top of that is subject to a 3.8% surtax. Okay, so it means that if my ordinary income from work was $225,000, and then I realize $50,000 in gains, the first 25 I only have to pay that 15% tax on. The next 25 I pay 15% plus 3.8%, 18.8%. Is this the end of the world? No, I'm paying taxes because I made money. Making money is a good thing. But if I could, let's say it's December of 2024, and I want to sell a holding, and I'm going to realize a $50,000 gain by doing it. If I book half the gain in December of 2024 and half the gain in January of 2025, I just saved 3.8% on $25,000 because I moved my income, not counting investment income, was low enough that booking only $25,000 of gains in each year kept my overall income across years under the threshold for net investment income tax. These are the places that we spend a lot of time as financial advisors looking at taxes. Where are we in relation to the brackets? This last slide that I have here. Are we at 210 or are we at 270? 270, the tax savings aren't going to be as substantial, you know, as if I'm right next to a threshold and I can kick myself under, I can save even more on taxes potentially. It depends on the issue at play. All right. So net investment income tax, something to be aware of. What does it apply to? It applies to taxable capital gains. It applies to dividends, passive income that I have from investments, interest paid from my bank accounts, non-qualified annuity payments. So if I'm taking money out of an annuity, not an IRA annuity, but a non-qualified annuity, and then rental and royalty income can be counted in there too. So a lot of things can be subject to the net investment income tax. One of the things I'd like you to think of as you look at a tax return is to just see what taxes you are being subject to, right? What are your specific methods for saving? Are you taking itemized deductions or standard? This is classic. I'm sitting down with someone who says, I am saving money by giving to charity. And I say, are you sure? And they say, of course, because I'm giving my receipts of what I'm giving to charity to my tax preparer every year. They're including it in my return. And I say, well, let's look at your tax return. And you then see they're taking the standard deduction. So you're giving a whole set of charitable receipts to the tax preparer every year, thinking that it's saving you money. In actuality, it's not saving you anything because you're not giving enough to kick yourself into the itemized deduction realm. You're still below what you would just get by taking the standard deduction. So get a little bit more deliberate about, am I subject to net investment income tax? Is there a way to avoid that? You know, am I getting the full benefit of my charitable giving? We'll talk about that a little bit later too. Okay. So then we get to a little counterintuitive idea, but it applies to what I was talking about a multi-year tax strategy. Sometimes it makes sense to do a Roth IRA conversion. What is that? It's taking money out of a traditional IRA and moving it into a Roth IRA. You can't do this inside the 401k structure. You can't do it inside the 403b structure. It has to be in an IRA to do it. But you're allowed to take monies out of a traditional IRA, deposit them in full into a Roth IRA. You then have to come up with the money to pay the taxes for that out of pocket. All right, let me say that one more time. I take $20,000, move it from my traditional IRA to my Roth IRA. I'm allowed to move all of it in there. I then have to pay the income taxes of that $20,000 because that was $20,000 that came out of a traditional IRA. I can't avoid that tax. I'm going to pay it. If I don't pay it, my heirs are going to pay it. Somebody's going to pay that tax someday. That's a tax that cannot be wiped away with death. But there can be years in which my income is quite low, and looking at my return, I say, I'm in the 22% bracket, but I'm only at $120,000 of income. So I've actually got $80,000 of room within the 22% bracket to soak up additional income into this tax year and have it only be subject to 22% tax. It's the most beneficial if I'm in this 12. You see this big change between the 22 and the 12? Let's say I'm $60,000 in income. Well, that's a really good place to use $35,000, $34,000 of Roth conversion, all subject to 12%. All in the idea that you're going to be subject to more tax later. So paying tax now is beneficial. There's situations where it doesn't make sense. If you expect in retirement to only be withdrawing from your IRAs and you've already moved a substantial amount into Roth IRAs, and so already you're going to be subject to a very low tax in retirement, now this idea of Roth conversion, not as important. A lot of financial planners out there are still going to say, hey, it still makes a lot of sense. But that now is based on a number of assumptions, right? The idea of saving money by paying tax now always involves a payback period. I've incurred tax right now that I wasn't going to have to pay for years. So there is a payback period on that. Let's say I had to pay $5,000 in taxes to do a $20,000 Roth conversion. That was $5,000 out of my pocket that would not have been otherwise. So when is the savings going to happen? It's going to happen over future years as the Roth appreciates and is not subject to tax. Where if it had stayed in the traditional IRA, it would have been subject to tax, every dollar of gain. So the Roth conversion is a very effective strategy, especially if you broaden your lens to think about 20, 30 years. And I even think about it cross-generationally. I think, well, when a child inherits a Roth IRA, they don't have to take the money out for another 10 years. So add another 10 years of tax-free growth onto whatever you would have experienced over your lifetime. But it does involve a payback period, because if I died next year after doing a Roth conversion, there's no question I would have paid tax when I didn't have to yet, right? Another situation like that could make sense to do Roth conversions is if I'm retired in a relatively low income tax bracket and my children are all doctors and are in the 35% tax bracket. Now I start saying, well, overall, if I think cross-generationally, it's much better for me to take money out and pay taxes on it now than it is to leave this IRA to my children. They're already in the 35% bracket, and we compress the number of years that they have to take the money out of the IRA, 10. You only have 10 years to take money out of an inherited IRA as a child. And so now they're kicking a ton of income into the 35% tax bracket that could have maybe been subject to lower rates if I had converted into Roth in earlier years. So a lot of these strategies, it's not that you're eliminating tax, it's that you're reducing tax. And you're reducing tax when you think multiple years, not when you just think of a single year. Because obviously, if I take money out of a traditional IRA this year to move into a Roth IRA, I've triggered tax that I wasn't going to have otherwise. I'm kicking myself higher above the line for this year. So I'm doing it with a multi-year strategy. Hopefully that's helpful. So you have more control over your future years RMDs. That's because as I've taken money out of the traditional IRA, it lowers the amount I will have to take out of the traditional IRA when I get to required distribution age. And it allows for a tax-free transfer of assets to my heirs at death. Okay. How can I make my portfolio tax efficient? We talked a little bit about that, right? The idea of using tax efficient investments. One of the great examples right now is exchange traded funds instead of mutual funds. Exchange traded funds buy and sell securities, but they don't buy and sell them. They swap them oftentimes. And when you're swapping securities instead of buying and selling, you're not triggering a realized gain. and you're not then triggering a gains distribution to your investors at the end of the year. So ETFs have really emerged as a tax favorable method of investing if you're using a taxable brokerage account. All that is meaningless if it's inside an IRA or a 401k. But inside a taxable brokerage account, you can save quite a bit in taxes that way. Another way of doing that is by using a direct indexing strategy. This has come up in the last 5 to 10 years, that software has gotten sophisticated enough that we can replicate what we would do inside an index fund with individual stocks. Why would that be advantageous? I thought I already own the stocks inside the bucket. Yeah, that's right. But if you own the individual stocks, now you can tax loss harvest positions that are down for the year and get a tax benefit that you would not have been able to get if you were just owning the whole bucket. I can't sell an individual investment inside my fund, but I can sell an individual investment when I own all the individual investments. High quality municipal bonds. These can be really effective. What I will say is, this is another place. Do not let the tax tail wag the life dog. If you're in the 12% bracket, don't be using municipal bonds. Why? Because municipal bonds are they're priced to be tax favorable on yield for people who are in the higher brackets, in the 32, 35, 37% brackets. And so you can actually find cases that if you use a municipal bond fund and you're only in the 12% bracket, you're actually making less after tax than you would if you just bought a regular bond fund that would have taxable income. Because at the end of the day, your interest is that much lower from the bond that you're actually coming out behind, right? So this is another case. Investing is a personal exercise. It matters very much what your bracket is as to whether a strategy is effective or not. But if you're in the 35% tax bracket, a municipal bond strategy can make a lot of sense. And you can even use a municipal bond strategy that focuses on the state that you live in, because then you can avoid, in some cases, not only federal taxation on the income, but also state taxation on the income. An asset location strategy, that's probably where I'll conclude a bit on investments. I mean, this is a tax call. I mean, taxes and investments are so integrated with one another, but asset location, what's the idea here? It used to be, again, that if I'm building a portfolio, I buy a set of investments in a taxable account, I buy a set of investments in an IRA, I buy the same set of investments in a Roth IRA, and all three accounts are going to be earning roughly the same amount. That seems like it's a good idea. But at the end of the day, each of those methods of investing has a different tax consequence. If I grow a traditional IRA, every dollar of growth someday is going to be subject to income taxes. If I grow a Roth IRA, none of that money will ever be subject to income taxes, as long as we don't change the tax code. If I'm in a taxable account, I get tax favored status, long-term capital gains rates on the growth. And if I hold to my death, it starts to look like the Roth IRA. I don't pay any taxes on the gain in that account. So which accounts would I rather grow more? I'd rather certainly grow the Roth the most, the taxable brokerage second, and the traditional IRA last. That now is called asset location. Put the right investments inside of each of those account types so that they're growing, the overall portfolio is growing in a tax efficient way. The most aggressive investments with expected highest return in the Roth, the investments with the lowest expected return in the traditional. So we don't want to grow that as much as the others, and then everything in between in the taxable. So again, I don't know your situation. If all your money is traditional, that's okay. You want to grow that, right? That's your retirement savings. I'm not saying not to do that. Maybe we want to do some Roth conversions after you retire. But if you have multiple tax status accounts, then we want to put the right investments in each. We talked about this earlier. Maximize your 401k. There is a unique provision to this year. I think I'll cover it in a couple of slides. We'll talk about it. But this, in 2025, you're going to be allowed to put $23,500 into a traditional 401k or Roth 401k for that matter. If you're 50 and over, you can put in an extra $7,500. That takes you to $31,000. And I always tell people, look first to what the match is inside of your retirement savings vehicle at work and make sure you're maximizing that. Even if you don't like necessarily what the investments are in that plan, When you put money in that plan, you may be getting a 100% return automatically. You may be getting a 50% return automatically. Why would that be? Because if I'm in a plan where I put in 4% and my company puts in 4%, that's a 100% guaranteed return. I can't find you that on any other investment out there. So make sure you are maximizing the match. After that, it becomes a question of, all right, where's the best place for me to save? Because I already got all the value I could out of the matching, and now I can look at where I want to save the rest. But get the match. Another thing I can do, I think this is about the last one above the line, is I can donate my IRA to charity. So this is only possible when I am 70 and a half or older, okay? And some of you are saying, I thought 70 and a half wasn't an important age anymore. We will talk about the Secure Act later. The Secure Act changed the required distribution age. But keeping people like me and CPAs in business, they neglected to change the rule on qualified charitable distributions. So now you have a required minimum distribution age that matters, and you have an age at which you can start giving qualified charitable distributions. Now, what are those? The idea behind a qualified charitable distribution is I give from my IRA directly to a charity. And when I do that, that's a tax-free distribution from a traditional IRA. So if you were giving cash out of your pocket to a charity and you turn 70 and a half, it becomes far more effective to you to move upstream and give directly from the IRA. Why? Because you were probably drawing from the IRA for income to live on, then you're giving after-tax money to the charity. You can give the same dollar amount to the charity pre-tax and never pay tax on it if you give it straight from the IRA. This only becomes possible after you turn 70 and a half. It's not the year you turn 70 and a half. So if you turn 70 and a half on December 1st of this year, don't do your qualified charitable distribution until December of this year. But it becomes one of the best ways of giving charitably once you turn 70 and a half. Now there's a sweetener to it. You can see in the maroon circle here. Once you turn 73, which is the required distribution age, if you give a QCD, it counts towards satisfying your required distribution. So if I have to take $50,000 from my IRA this year, I give $5,000 to charity, I now only have to take $45,000 out and subject it to income. So that's why we're talking above the line. We're taking money that was going to be income to me in this year, and we're taking it out above the line. Well, let's talk about a few below the line strategies. Here's the 2025 standard deductions: $15,000 for single filers, $30,000 for married filing jointly. Remember what I was referring to earlier. If I have paid off my mortgage and I have no mortgage deduction, and I only get up to $10,000 of my state and local taxes to use as an itemized deduction, so that's $10,000. I have to give $20,000 to charity in order to get $1 of tax savings on my charitable giving. The first $20,000 I'm giving charitably is only filling up the bucket to match what I was already getting in the standard deduction. So this is what I was referring to. You think that you're getting savings from your charitable giving, but if your itemized deductions are low enough, then you're actually not getting benefit. Now there's stuff you can do about that. Okay. Hold that thought. Let's talk about a couple other things below the line. I can use appreciated securities in my charitable giving. All right, let's say that I'm not 70 and a half and I'm 58, but I want to get the most bang for my buck out of my charitable giving. But I've been giving in cash to the Red Cross. I was taking $10,000 of cash out of my bank, giving it to the Red Cross. What I can do instead is give $10,000 into my portfolio and then take $10,000 of appreciated securities and give that to the charity. Most charities have brokerage accounts opened to accept. You would be surprised. Sometimes people think, no, my local church doesn't have that. And their local church does. You talk to the giving department, they say, oh yeah, absolutely. We have a brokerage account. Here's the account number. And let's go back to that Facebook example. So I got Facebook and it's highly appreciated. and I'm going to give Facebook stock instead of cash to my church. Well, the church doesn't pay tax on the gain when they sell the Facebook. They're a nonprofit. I don't pay tax when I sell the Facebook because I didn't sell the Facebook. I gave it to my church. And then sometimes people will tell me, yeah, but I love Facebook. I want to be in Facebook. Great. Take the $10,000 of cash, put it in your portfolio, and buy the Facebook. But now you have a higher adjusted basis in the Facebook investment than you would have had otherwise. So at some future point, when you go to sell some Facebook stock, you will have a lower capital gain because of engaging in this strategy. And again, this is a multi-year strategy. I love this. If I do that $10,000 a year for the next 10 years, I've elevated the basis of that investment, that Facebook, probably to the tune of $50,000, $60,000, $70,000 of extra basis that I'll have in there that I wouldn't have had otherwise. And I'm saving myself taxes in the future. So it's very, very simple to do. We're just giving stock into from the account to the charity and putting cash back into the account that I would have normally given. Now, we can run into some issues here if we have a lot of giving. And the bullet down here talks about 30% of AGI deduction limitations. So if I make $100,000, I can't give more than $30,000 in appreciated stock to the charity. I can give some other cash afterward. If I lost out on the rest of that deduction, I get to kick it forward to a future year. It's not like I've lost it altogether. But this is where we want to, again, be mindful and look at our strategies carefully. We can also give, though, into a donor-advised fund. Let's say I don't have a charity identified right now that I want to give to, but I want a charitable deduction in this tax year. Think of a donor-advised fund like a parking lot for my charitable giving. I give it into the fund now, and at a later point, I make a grant from the fund to a charity of my choosing. This is particularly relevant in a year that I sell a business, and I know I'm looking at business succession early. This is just, when things are the most logical time to talk about it in my mind. If I'm going to sell a business in this year and I'm going to realize, $2 million of long-term capital gain, I'm probably in a higher tax bracket this year than I'm ever going to be the rest of my career. And so it can make a lot of sense to take, let's say, hey, I know over the next 10 years, I was going to give $50,000 a year to charity. Well, then put $500,000 this year into the donor advised fund, get the full tax benefit this year in the super high tax year, and then give it out to charity over the next 10 years. You only get the deduction the year you contribute to the donor advised fund. When you make distributions in future years from the donor advised fund, there's not another charitable benefit. You're just giving directly to charity. Now, these are not free. The Schwab has one, Fidelity has one. There's a couple of other institutions that have donor advised funds set up. They will charge you, I think, about 0.4% is the typical fee for having money inside a donor advised fund. But if you look at the huge benefit of bunching all of your charitable giving into a super high tax year, that can be well worth it. All right. You get a tax deduction in the year you make the donation. And I'll just soup it up another step. If you're selling that business and you realize this far enough in advance, you may be able to gift a portion of your business directly to the donor advised fund and avoid the capital gain altogether on that sale. That's the thumbnail you're going to get here. If I go into it longer, then there's a whole lot of other people that are going to be bored on this call. But that's the thumbnail I want you to think of. If you're thinking of selling the business, you haven't got the final buyer yet, explore what it could look like to gift a portion of your business into the donor advised fund. So again, you get the double tax savings. You get the charitable deduction and you avoid the capital gain on selling a portion of the business. Okay. So here's an example of how I'm going to benefit from that DAF bunching. I've got here in blue and green the standard deduction, $30,000 a year, right? Every year. But let's say that in this year, I do $150,000. I'm sorry, $205,000. So 5 years worth of deductions into the current tax year. I save a lot more in taxes than if I would be giving those amounts every year in the future. If I give them every year in the future, most of the gifts are getting eaten up. Now I'm assuming that I don't have a mortgage and I'm not benefiting much from state and local tax, right? So that's, you can see in the assumptions below here, $30,000 standard deduction, $75,000 charitable deduction, and $10,000 of property tax, state and local tax. So if I'm giving $15,000 a year to charity, I am not coming over the standard deduction threshold any year. I'm never getting the benefit, but I give it all to a donor advised fund in a single year, and I push 4 years of amounts of charitable giving into a single tax year, and I move something from not being beneficial to me from a tax standpoint to being beneficial. Okay. All right. Secure Act 2.0. I told you there was an act that came out a few years ago. The provisions have been filtering in to our lives over time. The first change that was made by Secure Act 2.0 was an increase in the standard, the required minimum distribution age from 72 to 73. It was 70 and a half. Secure Act 1 moved it to 72. Secure Act 2 moved it to 73. And in 2033, it'll move to 75. So anyone in their 50s on this call, 40s on this call, you will not have to take amounts out of and some in their 60s. You will not have to take amounts out from your IRA until age 75. To me, as an advisor, that I love that because it just expands the window under which I can do Roth conversions. I've retired, my income's dropped substantially. I don't have to take amounts out of my IRA until the future. And so I've got a lot of years here to play around with taking some extra money out of the IRA, putting it into the Roth, knocking down the amount that I'll have to take out of the traditional IRA when I turn 75. The other nice provision that was made immediately of 2.0 was it reduced the excise penalty from 50% to 25% for RMDs. If I missed a required distribution, and my required distribution was $20,000, then I have to make when I realize that I have to make the distribution in a future year, and I have to pay a $10,000 excise penalty. Now, in point of fact, in most cases, CPAs were able to kind of argue that and say, hey, this is the first time this has ever happened. Can you please waive the excise penalty? They were. I would submit with the reductions here, it's been moved to 25%. And if you correct it in a timely manner, it's down to 10%. I think they're not going to waive that. I think that we've actually moved into territory now where, well, the penalty is only 10%. So you're going to make the $20,000 required distribution, and you're going to pay a $2,000 excise penalty. Don't miss your required distributions. Make sure that you do them every year. But the impact financially to you if you miss one is theoretically less. I think maybe de facto it actually might be a little more. Pre-death RMDs from Roth 401ks were eliminated. You used to have to take money out of a Roth 401k along with the money you had to take out of a traditional 401k if you had reached required distribution age. Now they've said, no, we're going to splice the two. You have to take out from the traditional portion. You don't have to take out from the Roth portion. That's a nice change. The other change you may have heard of already, if you've had college students and 529 plans that you're using, a 529 plan, a portion of it, can be rolled over into a Roth IRA. The child needs to have earned income up to $7,000 of earned income, then you can move $7,000 into the Roth. The 529 has to have been open for 15 years. The specific contributions in question have to have been in the account for 5 years, and you can do it over 5 years, but it's not like you can duplicate. It's not like you can roll over and your child can contribute to a Roth as well. It would count as your child's contribution to the Roth. But it's a nice way of soaking up extra monies in a 529 that we're all otherwise kind of stuck in there. The other one that now we're getting to 2025. This is the brand new one. You may have heard of it. There is an extra catch-up. So right now you all know, hopefully, you can put $7,500 more into your retirement plan when you turn 50. Well, no, you can put $11,250 in for the year you turn 60, the year you turn 61, 62, and 63. For those 4 years, you get to make an extra catch-up of 50% more than the usual catch-up. So that amounts to $11,250 this year. So if you are in that age range and you have not made a change with your employer, you may want to make that change and increase to the extra catch-up you're now allowed to do in this year. That's hot off the press as of 8 days ago. And then I'll just kind of give a touch on some advanced strategies. And this is just to say that I can only go so far in a 1 hour webinar on the tax saving opportunities available to you. We can get much more in depth if we know what your personal situation is. But for example, let's say I have a large charitable intent to my university, and I want to give them an amount in the future after my death, or after a period of years. I can set up what's called a charitable remainder trust. I put the money into the trust. I receive income from it over a period of time. And at the end, the university gets whatever's left over. I can also do the opposite. I can put money into a trust, give to the university over a period of years, and then the money that's left over at the end can go to my children, my grandchildren. So that's a way of, again, of accelerating tax benefit into a current year that I was going to lose otherwise. This, to me, and it bridges over to estate planning, but sometimes people come to me and say, I'm going to give $1 million to charity at my death. And I say, why are we doing it at death when it's not helping you at all from an income tax perspective? Why can't we shift some of or all of that gifting into the coming years and use it during your lifetime, so that you're not just getting the charitable benefit at death, you're also getting an income tax savings during life? All right. So, charitable giving, you already have to have the intent. Again, don't let the tax tail wag the life dog. If you weren't already inclined to give to charity, you're going to lose money by doing this deal, because you're giving up dollars to a charity that otherwise would have gone to your family member. But if you were already inclined to give charitably, there's many ways of doing it that's going to save you extra income taxes, and that's what we're talking about. Let's bridge for a minute into business succession. This is just, I want business owners thinking long in advance of selling a business of ways that they can save money. You want to make sure you understand what your basis is in the business, what you put in, and what the business is now worth, so you can project what your capital gains is going to be. It may make sense to do a multi-year sale of the business to recognize income from that business over a period of years and knock down the long-term taxes that are paid, right? That could make sense. We could reduce capital gains by giving a portion of the business into the donor advised fund prior to the sale. That's a method of saving money. We can use trusts to transfer businesses to the next generation as a way of getting something out of our estate and extracting the growth from it, so it's not going to be subject to estate taxes for us. All right. And definitely, as I'm preparing for a year in which I'm selling a business, this is again kind of cutting edge stuff, but just in the last few years, there have been these strategies that have been emerging that are designed to create losses, taxable losses, at no expense to your long-term portfolio return, specifically with the interest of reducing long-term capital gains. And that has huge application in the world of selling a business. If I know I'm going to sell a business in 5 years and I'm going to have a $5 million realized gain, I can implement certain strategies in my portfolio that will kick off losses in each of the following few years to accumulate losses to make a huge dent in the tax that I'm going to pay when I sell the business in a few years. And unlike charitable gifts where I'm saying, hey, money's coming out of your pocket, this is not, money's not coming out of your pocket. You're saving dollars. See, it's really hard to save money on income tax. You generally have to give up something to get something. I have to pay for education in order to get the tax credit. I have to have kids and all the expenses accordingly to get a child tax credit. I have to give to charity in order to save money. On selling a business, capital gains, I can avoid the tax altogether at no cost to myself. There's strategies that have emerged where I can book losses to hedge against that. All right. So we've covered a lot of ground here. I want to make sure I have a little bit of time for questions at the end. I want to make sure everybody, is looking, yes, at their business, at options they have for legal agreements, due diligence of buyers. We're bridging over to other topics there, and we've kind of run out of time. I want to get to questions. But the bottom line is, there are many ways of saving money on taxes. They mostly involve thinking forward instead of thinking backward. So if you take one thing from today's call, it would be to think about 2025 taxes now at the beginning of the year. What is going to change in my life this year? How do I account for that? And talk to my tax professional early so we can plan around it. All right, because tax planning is done forward. We try and do tax planning in reverse. There's just so many doors that are closed to us already. All right. So if you have interest in talking about your personal situation, you can click a link that's going to show up in the chat. to schedule a 15-minute consultation with a Savant advisor. You're welcome to talk with us about your personal situation. I just think, like I say, we can cover a lot more ground about you in those 15 minutes than probably you can get from an hour of me talking about everybody. But we're happy to chat. And again, if you didn't get your questions answered when I go through them here, make sure that you post them in the survey afterwards so somebody will get back to you. All right. Let me make sure that I get to questions now. All right. So let's see. The first one I had was, how does the Tax Cuts and Jobs Act sunsetting affect me? And the answer there is, so the Tax Cuts and Jobs Act, we were very concerned. There were a lot of headlines as to what is going to happen with the new tax bill, even as recently as 3 months ago. But really, we kind of feel like we have a general direction of what's happening. It's going to be pretty similar to what the past bill was. I like, for example, we had a lot of concern about estate taxes. Hey, it may make sense to accelerate gifting into 2025 because the exemption might cut in half, and really pivoted off of that kind of overnight, right? And so we're just looking at probably an extension of similar. There's been some discussion about raising the current $10,000 standard state and local tax limit. In high tax states, you might be able to deduct more of your state income taxes. But we're just going to have to see what emerges from the next Congress. But keep your eye on it. Generally, tax bills don't look retroactively. It's really tough to go backwards to the beginning of a year when you pass a bill. It's not that it can't happen. It's just most of the tax bills of late I've seen get passed somewhere in December because they're really hard to pass, to get all the agreement that you need to pass the bill. And then they kind of look forward. Seldom look backwards. Not to say they can't, but seldom do. All right. How will you know what tax bracket you are in the future? It's so far away. Yeah, we're always in that world. The world is, I have to plan as well as I can with the information that I have, So the best thing I can say is, I think generally, and this is not science, right? But it is general logic, I would say, that tax rates ought to move up in this country over time. The thought is that, well, debt is growing and growing and growing. That needs to be paid off in some respect over time. And so probably the trend is to higher tax rates in the future. So use that. Again, like there's never a set rule until the tax bill passes. And even then, a new tax bill could pass 2 years later. But so we just take the best we can with the information we have and plan accordingly. Okay. Is pension income subject to tax surcharge? It is not. Pension income is not considered passive income. Passive income is related to a business I have that I'm receiving income from, but I'm not actively involved in. Should you just put money in a Roth 401k instead of a regular 401k to avoid having to roll over? That's completely up to your tax situation. It's a tax arbitrage question. Are you in a low tax bracket right now? Are you going to be in a higher tax bracket in the future? Maybe then Roth makes sense now. There are advisors out there saying do Roth all the time, because they're thinking generally tax rates will go up and getting that tax-free growth is going to be beneficial. I say, if I'm in a really high income tax year and I could use a deduction, it's a pretty easy deduction to take money and put it in the traditional side. There's a question about NUA. That is definitely one you're going to want to post in the chat afterwards. NUA is net unrealized appreciation, and it's a very good topic. But far broader than I could cover here. How is a Roth IRA not subject to tax ever? Why would the government create this option? The reason is they accelerate. Actually, the government loves the Roth IRA option. Why? Because they are accelerating taxation into this year. Government would always rather get your tax dollars now than get them in the future, right? Because they generally plan out only a few years. So think of them like your needy 16-year-old. If you tell your 16-year-old, I'll give you, $100 a year over the next 5 years, or I'll give you $300 right now, they'll take the $300 right now in a heartbeat. They won't even, and that's what the government's doing. They're saying when you put money into a Roth, you're paying income taxes on the dollars that you put into the Roth. You're not deferring the tax like you would in a traditional. All right, time for one more question. I donate to charities throughout the year and I want to lower my taxable income by giving more money via QCD. It leaves less in my pocket. Well, If you donate to charities throughout the year, I would probably and you're doing qualified charitable distributions, I'd consolidate that giving into 2 to 3 times a year instead of monthly. And the idea here is that no, you're giving from the IRA, so it's not coming from your bank account, it's coming straight from the IRA. So you have cash in the IRA already, it's there, right? You just give it directly from the IRA to charity. It actually reduces the amount you have to take out from the IRA, because you were taking money out of the IRA to live on. Part of what you were living on was money you were giving to charity. I'm just saying give it to charity before it ever hits your bank account. Give it straight from the IRA to charity. All right. That's the time we had for questions today. Like I say, go to savantwealth.com if you have additional questions about us, or make sure to reach out for that 15 minutes complimentary consultation. We want to get you the answers that you need to make better decisions for your financial lives. Thank you and have a great day.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.